welcome to the Core Invest Mistakes and Risk Management series.
And today we are going to talk about trade entry and boosting your probability of winning.
And if you have been following our video series, this is on the mistakes and risk management. This is the third video. We have previously talked about trade preparations, trade selections, and today trade entry.
Yes, and as what Wai have mentioned, we have 6 topics over here, and we are on the third topic, right, the trade entry. And there will be 3 more series that we are going to come up with regards to mistakes and risk management. So please stay on and continue to watch our videos.
Quick introduction of myself. I have been doing investment for the last 25 years. I was doing stocks for a while, and then in the recent years, I've been delving into the options. And since about 2 years ago, I've been teaching options and stocks with Jeremy.
Yes, and I'm Jeremy over here, and I've been investing for more than 10 years. I've been in the hedge fund administration and compliance, and this is where I can share a lot of my experience with regards to investing and trading in the stock market.
And of course, as usual, before we begin, we want to make sure that you understand whatever we are sharing, Jeremy and myself, it is based on our speaker's personal capacity. They are not meant to be of any recommendation. It is for your education and entertainment. Please always do your due diligence. There are examples I will be showing, and past performances never guarantee the future outcome. Please make sure that you do not distribute, circulate, or copy of this material here. Thank you.
Right, so when it comes to trade entry or any kind of investments, we are always looking at what kind of potential mistakes that normally we make. And we must agree that it's a fact that everyone makes mistakes, right? And look at who is most prone to investment mistakes. As you can see that people who are 10 years and above, right? 10 years and above of experience, right? And more will have about 19% of the chance that, of 90% of the population are actually making mistakes. So what about those who are new entrant, right? Those are consists of 49%. So everybody makes mistakes. Is how we manage it and how can we avoid it, right? So this is where trade entry is very important that we have this series for you today.
So for trade entry, do avoid some of the mistakes that we are going to talk about. As we have a little cartoon there, duh. Don't make these mistakes, okay? There are 7 of them. Not following SOPs are one of the very common ones. Entering during volatility, on emotions, high price, wrong setup, or entering during uncertainties or when events are coming. And also entering sometimes at weak strength if we don't do our homework. So do avoid these 7 mistakes, and we're going to go into detail in every one of them.
Right, so mistake number 1, not following the trading rules. This is very important because in terms of, we look at those investment gurus like Warren Buffett, they have their own investment and trading rules, right? If you do not have those rules by yourself, you're actually lengthening your learning curve. Right, that's why SOP is there, right? Many people have their own learning curve, right? Learning journey, right? It depends on how much time you have put in, how much confidence, how much experience, and you can see that as of experience, time, and confidence level, the more you do, the better you are, right? So what can we do to actually reduce our learning curve, right? And this is where, in terms of performance and time, we can see that definitely there is a chance, right? Small chance that you may make mistakes and lose some money. But at the end of the day, how can we reduce the chance of making those mistakes and losing money and shorten the learning curve, right? So this is where we want to reduce our time in making mistakes and increase our time in successful investment trading, right? This is why this is very important in terms of our learning journey.
Yeah, additional point here is many people, of course, if they sustain and be consistent enough, eventually there will be improvement over here. But a lot of people actually gave up, even before they reach that site, and they will just give up and go. So this is just to make sure that you avoid these kind of mistakes as early as possible and to reduce the learning curve. So let's look at the second mistake here, entering during volatility. And we know that during the first couple of minutes, 15 minutes or so during the market open, these are the time that the buyers and sellers will be putting in all their entries, and there will be quite a bit of volatility during that period. So this is a 5-day chart, as you can see. The market opens, and this is the market end. So you can see that even at this period, there is a quick increase, and then suddenly that it drops, right? There's a good increase over here, but end of the day, it is also, this is even more interesting. When the market opens, it drops suddenly, and then it picks up throughout the day. So during the first 15 minutes or even up to the first half an hour, volatility is there. And usually if you want to enter, let's say, a 1-month trade or longer, don't have to enter at that particular time. Do it a little bit later when the market stabilizes, okay? And usually the best time to trade is New York time, about 10 a.m. to noon time. That is the morning part where you have enough volume over there. And when market opens at about 9:30 to 10 o'clock, that's where volatility is. So do enter when market is more stable.
All right. So mistake number 3 is to enter on emotions. So most of the time when you listen to someone sharing you about a company, right, normally it's the time when the price is high. Okay, so we have to be patient, avoid impulse and emotion, right? Read news with a pinch of salt, right? Why do we need to do all this? Because it is a fact that most of the time, all these news and announcements, most of them are manipulated by foreign agencies, right? This is because of the biasness against their investment portfolio. Imagine that they are buying the price up for a certain company. They'll talk everything good about this company because they want people to listen to them and buy it up. Right, and vice versa, there are people who are not buying the same company but selling against the same company, and they'll say something extreme that is very bad about the company, right? So you got 2 extremes, one good, one bad. Which one do you want to follow, right? And the answer is to not follow, right? Because most of the time they are fake news, especially online, because this causes you to be misinformed and have impression about the issue. Okay, so read with a discerning eye and approach news with a pinch of salt. Cross-check with other sources, right? Those unbiased news sources, and then take your time to digest the content to form your own opinion. At the end of the day, if that company that I mentioned just now is a company that you have invested, you probably want to fall back to the fundamentals on why do you want to invest in the first place, right? So again, as I mentioned, people tend to fall to the cycle of market emotions, right? When someone tells you about the stock, most of the time, the price is already high. Okay? So when the price goes up, you'll be very happy. But most of the time, the price is already high. It will contract and retract back, right? So this is where the price comes down, and this is where people will get fearful and disappointed, and they'll start to sell at a low price. And then the market emotions repeat until they lose all their money. Okay, so again, at the end of the day, right, understand the company fundamentals well and hold it for long period if you think that the company is good, or if you are an experienced trader, look at the technical chart and see your best entry and exit so that you do not fall into the prey of all these foreign agents.
Let us now look at the next potential mistake. Mistake number 4, enter high price underlying. So very often we think that if we take a stock or underlying which is more expensive, we tend to make more money. Absolute dollar, maybe, but in terms of return on capital, could be a different story. So let us take an example of a stock less than $100 versus a stock which is more than $100. Let's compare the return on investment or return on capital. So let us now take a look at the example. So I have here a Pfizer, which is a pharmaceutical company, at a price of $37.47. This is less than $100. Second example that I will show you is RMD, which is ResMed, and this is about $212. So it is about 6 times more expensive. Let us compare the return and see. So on the left side here, Pfizer, you can enter a 10 lot, and that is giving you a spread of 36.5 and $36 over here, you'll see that the profit is $170, a max loss of about $330, and you have a buying power which is equivalent to your capital. Okay, buying power is power to buy, which is capital, and that's 343. So what is the formula of return on capital? And that is premium that you collect over buying power. In this case, it is $170 over 343. That gives you how much? That should be about 49% on return of capital over a 22 days. All right. So let's compare again the next one, RMD. Market price is 242. All right. And you have a profit of 144. So let's write down return on capital is $144 over the buying power of how much? Sorry, I had to do this. Okay. Of $858 over here. And what is the ROC here? The return on capital. That's about 17%. So you can see that for a more expensive RMD, $242, you get a return of 17% versus a Pfizer of $37, you get a return of 49%. So you can compare and see that actually you are making about the same amount of money, $144 versus $170, but the return is so much higher in Pfizer. Therefore, cheaper stock like Pfizer, which is less than $100, actually gives you higher return on capital versus a more expensive one, which is only 70%. So it is a myth that more expensive stocks give you higher profit. In this case, comparing RMD, which is healthcare, versus Pfizer, both are healthcare, you get very different results. Okay, so that's a myth for you to remember. Let's move on.
All right. So mistake number 5 is to enter at the wrong setup. Okay. So this is to share with you one standard deviation. One standard deviation shows that 68% of the time, right, the price will fall within this area here, right? The market price will fall within this area. So if that's the case, when we look at the market price itself, what can we look at in terms of our options? So in terms of a seller point of view, we'll look at the probability OTM, and we want the price to be at least above 50%, right? So that's where you'll have a higher chance of winning. So this is where you can look at 93%, 84%, 66%. You can see that these are all at a seller's point of view. This is beneficial for you, which is higher than 50%, right? From a buyer's point of view, you want to look at those that are in probability in the money. And that is where you want the chance of winning will be higher than 50%. That is where you can choose here between 77%, 88% or 64%, right? So this is where your probability of winning will be higher on the seller and buyer perspective. How about the open interest, right? Open interest is talking about the volume, talking about whether people are transacting with you. You do not want lower open interest, you want higher, right? Because of liquidity issue. Imagine you buy in, you can't sell back, right? So this is why we have to look at the open interest that are higher, right? So as high as over here, 11,000, that is great, right? The higher, the better it is, okay? And as what Wai have shared with you earlier on, right? Having a lower spread, right? Comparing Pfizer versus ResMed, right? ResMed is a $5 kind of a BP, $5 spread, whereas the Pfizer is a 50-cent spread, right? And you can see that Pfizer is getting higher return and lower risk. Okay, so with a right setup, you should look at a smaller spread with better returns. Therefore, will give you lower risk. All right. So this is why entering at the best setup will be more beneficial to you, right? In terms of investing successfully.
Okay, let us look at the next mistake. Mistake number 6: entering at the uncertain period or when there's event coming. What do we define by events? It could be a launch, a product launch. It could be merger acquisition. It could also be during earning calls or dividend date. And if you go to your broker system, these events are usually indicated. For example, this is Think or Swim system, and you can see those red telephone marks over here. It shows earning calls, where on a quarterly basis, company would announce their results. And you can see also the green button over here, right? A dollar sign, that is dividend date, where during that date, the X date, dividends are paid out by the companies to the investors. And during this period where there's event, usually there is volatility, especially when the company announces their results, whether it is good or bad, and it will cause some volatility. Also for dividend, a lot of people who are doing dividend play, they like to buy before the dividend is paid, all right, on the X date. And once X date is over, the investors also like to sell. And usually, you can see some kind of volatility or sell off during that period. So let us take a look. So these are volatility period, and you can see that it has been pretty stable. And suddenly, after the earning call, there is a big drop over here. Okay, and you can see the following quarter, not much volatility. This is also can happen. The following quarter here, it picks up and becomes stable. But you look at the next quarter, from stable to a big drop, and then picked up just prior to the dividend date. Is actually a gap up, and then volatility is here. So you see, there is always no certainty during this period. It can be a stable price movement, or it can be a very volatile price movement. In other words, uncertainty is there, and for new players, it is best to avoid such incidences, okay? Unless more experience. In fact, some traders like to do only the volatile period. For example, they will look at the earning calls, and during this period, look at this, this light pink graph. There is volatility just prior to the event, and after the event, after the earning call, market drops. So you can see for the past 8 quarters, it will indicate to you the volatility during the earning call. And there are some experienced traders who will just use this as a volatility play. Okay, so for new players in options, it's best to avoid this period.
Right. So mistake number 7, which is enter at weak strength, right? So this is the point where you want to look at basically your setup as well, right? When you enter, you want to enter at a good entry, right? It's far more profitable than repairing one. So you can see that you can choose many different kind of areas to invest in, right? So if you do not see the chart well and you look at the volume, it's not high enough, right? Tendency is that your chances of winning is lower. So ask yourself this question: do you want to enter here at this point, or you want to enter here at this point? Okay, or do you want to enter here at this point or enter here at this point, right? So again, this is all based on understanding the market cycle and also the volatility, as what Wai Ming have shared. And that is where we want to look at a strong entry, and then we will let it grow from there. Okay, so this is why entering at a good strength, or a strong strength, is always better than entering on a weak one.
All right, so in summary, these are the 7 areas where you want to take note of to avoid such mistakes. Not following the SOP, so do have some SOPs in place. Avoid during volatility, because that's where you have a lot of uncertainty. Sometimes it is emotional. Avoid emotions, okay? You avoid emotional news or news that can be misleading. High price is not always the best price, okay? Sometimes the lower price, as you can see from the example of Pfizer versus RMD, Pfizer at a lower price gives you higher returns. Wrong setup. You must have the right setup in order for you to make the profits. And of course, uncertainties and events are always not very good for entry. Enter only when you're certain. When not certain, avoid the market. Enter when you have a strong signal, not enter at weak signal. So these are this summarizes the 7 potential mistakes that many people would fall into.
All right. So I hope that you understood the trade entry well. And these are the news and updates that you can actually follow through. All right. So we have a program which is Profit with Options. If you are interested to know more how to trade independently and professionally with higher winning rate of options trading, that is where you can scan the QR code, and then we'll see you on the Zoom sessions. If not, you are interested to look at more into free education about options, you can always follow our Facebook private group, right? And then there is the Modern Power Investor options, so you can scan the QR code over there.
So that's all this time for our series on mistakes and risk management. We have got 3 other series. Do follow us as well. We have market insights, low capital investments for new option players, and also we will analyze the sectors in the S&P. So do follow us.
All right, so thank you for watching this series, and we'll see you on the next one.